everybody. Welcome to Friday, another Talk Money with Tom show. Our objective is to try to help you have a better retirement. And we do that through really question and answer about investment management, retirement planning, tax planning, etc. And so you can feel free to send in your questions at any time during the show. We'll try to answer them live. We got the email address here at asktom at talkmoneywithtom.com. You can also put them into the chat box if you're signed into YouTube, and we'll try to answer those live. You can send in those questions at any time during the week. Give us a little time to work on them. And then obviously we cover questions that came up in our strategy sessions from our clients that we think are important for everybody to understand. This particular channel was put into place really as a tool to try to help people create a better retirement through education. And so we're really going to try to push through, the concept of getting everybody out there as much as possible to a higher level in terms of how to deal with this. So even if you're dealing with another advisor, still might be useful to take a look at what we have on the channel. We have over 800 videos on the channel right now, and we're constantly putting out new ones. Do a daily update on what I see happening with the stock market Monday through Thursday, and then we have this live show on Friday. So you can subscribe to the channel by hitting the subscribe button. You can hit the little bell next to it if you'd like to get notified when we put something on there. And then I guess the last option is really just you can set up an appointment with Ethan and I, and we can get together on a video or a phone. You go into our website. There's a link right here on the channel. Right up in the corner is a button, looks just like this. It says book appointment. You click that, and you can schedule a 30-minute video or phone call with us, and we can, it's a start just to see, what do you need and what's the specific situation that you're in, and we might be able to help you with as far as that goes. So really excited, as usual, about this show, about today, and hopefully that you get something good out of this, and we can really kind of move you forward in terms of your understanding of how to have a successful retirement as far as that goes. I do like to start off each week with a summary of what I saw happening with the stock market this week. I'm going to use a little bit of a different view here because I've got some charts that are a little bit dense, so I want you to be able to see everything. This first chart is just the S&P 500 so far this year. If you look right here, the last 4 bars, because this is a short week with the holiday on Monday, really we've just gone sideways this week, which I see as really kind of a victory altogether since we had such a big run. If you see that low point that's right here off of my hand, all the way up to the high that we had close of Friday, that's over 9% run. That's a really big run in a very short period of time. And that's why, we want to stay invested in these markets at this point in time, just because these runs can happen so fast. If you're trying to get in and out, you can easily miss out on lots of them. This week has been very interesting in the sense that we've had what I consider some fairly good numbers, but the market has reacted all over the place about them. And the articles that are out there are kind of all over. I'll give you an example. So the number of job openings report came out this week, and it was down from the all-time high. And not a lot, but a little, and the direction is really important in my opinion. And the job openings is one of the things the Federal Reserve is really focusing on because they feel like there's too many job openings versus how many people are unemployed. It's almost 2 to 1. There's 11.5 million jobs open now. It was 11.9, so things have come down. But there's one side of the market that thinks it hasn't come down enough, that means the Federal Reserve is going to have to get more aggressive. And another side of the market that says, wow, it's coming down, things might be slowing down too much, etc. I think you need to have a slowing of the economy and a slowing in certain areas. And man, this week we saw a lot of things I think show some slowing, but not too much. And that's exactly what I'm looking for. So we saw the wage increase, the hourly wage increase actually slowed down, which I think is important because you can't have wages go up and up and up and up because that creates an inflationary environment because they'll eventually pass that along to us in terms of cost. We saw the number of new jobs created that came out today, 390,000, was higher than expected, but quite a bit lower than last month. And so the market's down today because it was higher than expected, and the market's afraid that means the Federal Reserve is going to have to get more aggressive. But I'm looking more at the trend. And everything that I'm looking for in terms of pieces slowing down, and I think at reasonable rates, is happening between May and April and March. We're starting to see peaks in inflation and all of these different areas. It's exactly what we need to see. I would assume right now that the Federal Reserve is pretty happy with what's happened, because most of what happens for the Federal Reserve is they do something and 6 months later the economy kind of finally reacts. So what we're looking at right now is what's been done in November, which is when they really started talking about raising interest rates. And so as we go, they start raising interest rates in March, and so maybe that'll be impact in September, et cetera. There's a lag. And I think they'd be satisfied to see what has happened so far as that goes. So again, market is hanging in there. Is this going to be a recovery or a short-term bounce and we get back down to these lows and maybe even lower? That's the big question. I do think that this week I'm very satisfied with at least a sideways motion after a 9% run back. We didn't give it all back. We didn't continue to run up and stretch the rubber band too much. A pause here I think is very positive. It's also a holiday week. Be super careful of trying to, analyze what's happening during a holiday week, because the volume can be very low and you can have a lot of different weird things pushing the market as far as that goes. I do want to present some of the indicators that I'm using to look forward at a recession. And I have 3 here that have demonstrated in the past some very good predictive ability on future recessions. And I think that's the difference. If this market kind of is able to hang in there because the economy doesn't go into recession, we might have already set our lows or be very close to them. If we have a recession, the market could go down a lot farther. So the focus, in my opinion, right now is recession or not. And so one of the key indicators I use, I've presented this multiple times, I won't spend too much time on this, but is the leading economic index. This is a basket of 10 different indicators. And you can see the gray lines are recessions. It's had a very good predictive ability, 18 months before, 11 months before, 21 months before the big recessions that we've had here, in the last 20 years or so. And so right now it peaked in March, came down a little bit in April, but it has to come down more before we can call that a peak as far as that goes. So still no signal here of a recession on an early basis. And then I'll show you a couple of others that I use. This is actually done by the New York Fed, and they take the 10-year Treasury yield and the 3-month Treasury bill yield. And what they're looking for, and the 3-month is actually a special, it's a secondary market, the 10 years, the constant rate. So I won't get into weeds as far as that goes, but essentially what they're looking for here is when the 3-month pays more than the 10-year, the bond market is signaling a recession. And it's very, very accurate, especially if that negative scenario lasts for 3 months or longer. And if you look back at this, you can see where it crossed through zero quite a few times right before, within 12 months a recession happened. So very good indicator to use, very popular indicator as far as that goes. If we look at it right now, it's going straight up. What that means is it's not going to zero. We're actually going away from inflationary pressures when that line is going up. Now, one of the things that the New York Fed does, which I really like, is this chart here. And this is the probability of a U.S. recession over the next 12 months, looking at the 3-month and 10-year yield. So what they've done is they've gone back to 1959, and they said, okay, whenever the yield is at a certain spot, what the differential between those yields, what is the how often did a recession happen? Now you can see this right over my shoulder. Oops, wrong way. Right over my shoulder here. We're actually down to a 3.7% probability of recession right now. So actually it's the end of April, but it didn't change much for May. We'll see what happens when they come out with the new numbers. But nonetheless, very low probability of recession is being indicated by this very accurate historical yield spread. So consider that. So leading indicators aren't showing a recession yet. 3-month to 10-year yield, not really showing a recession yet either. And then this is a lot of data here, but this is from a company called ClearBridge. This is 12 different indicators that they've identified. And I really like this breakdown. They do a little green arrow if the indicator is still not showing any recession in 12 months, a little yellow circle if there's some, caution, it might, be getting closer to showing, or a red X if it's basically that particular piece. And, they have housing permits and job sentiment, jobless claims, retail sales, growth in wages, price of commodities. ISM new orders has to do with manufacturing new orders, profit margins, truck shipments, credit spreads, money supply, and they have the yield curve in there, right? So that's, again, you'll see that in a lot of these. But I do like these baskets, and they have a green arrow here at the bottom for their overall signal. And you can see it by month. So for example, in March, we had just one red X and one, yellow circle. And now we have 3 yellow circles and 1 red X. So we're closer to a recession in this particular indicator, but still pretty far away. And one of the things they do that's really nice is they do this chart where they do what they call a comparison. So current is the farthest one over that we just looked at. And then they've got all the different recessions, 2020, 2008, 2000, 1990, 81, 80, 73, 75, and 69, 70. If you look closely at these, you can see how many red X's and yellow circles there were 12 months prior to the recessions that happened historically. We're nowhere near that right now at all. This would be a very unusual recession. It's possible. It's a very unusual time frame, but at least this indicator is also showing, similar to what we saw with the Treasury yield, similar to what we saw with the leading economic indicator. We're not seeing big, pushes right now on the early indicators towards recession. And so that's why you got to be careful about jumping in and out of the market or shorting it or going inverse, because the average downturn for the S&P 500 since World War II without a recession is 15%, and the average downturn with a recession is 36%. I mentioned those numbers a lot. And so really the core thing now is, are we heading towards a recession or not? It could happen. I could be saying something different a month or 2 months from now, but that's not what we're seeing right now. We are seeing a slowing, but that's what we need to see. It's just a matter of the pace of that slowing. Does it kick us into recession or just bring us down enough to kind of fight inflation, right? So that's what we're looking at. At the moment, things are okay. I know that, there's a lot of different opinions out there, and there's certainly a lot of articles talking about the impending recession, but that's partly because those get a lot of clicks. And so anyway, if you look at the real data and some of the indicators that are leading, I think it's worth, noting that there's an awful lot of them that show that there's not a recession coming in the next 12 months at this point. So something to watch as far as that goes. So nonetheless, I want to thank everybody for watching the summary this week, and I look forward to talking to you, again about it next week. All right, Ethan. Let's see what questions we have today.
So our first question is, how do I take a withdrawal during a down market?
How do I take a withdrawal during a down market? Yeah, that's a good question because we've got this scenario now, right? Mm-hmm. I'll tell you what we've done, because there's a lot of different situations that people might be in. But one of the things is to have a strategy long term, not just for now also. So what we do is we create these portfolios, the pie charts essentially. We keep a certain amount of money in the money market. And when somebody's doing withdrawal, what we will do is take out about 6 months worth of that withdrawal and we put it in the money market. And then the withdrawal happens, and every 6 months we'll go back in and replenish that money market to accomplish that withdrawal. We call it a systematic withdrawal, right? So it allows us to stay pretty much fully invested and then be able to withdraw off that money market. So at the beginning of this year, I actually upped that and put more money into the money markets of people that were doing withdrawals. I felt like the beginning of this year was going to be volatile, and it has been. And so far this year, our clients have been taking money from the money market. So even though the stocks and bonds are down, they haven't had to sell those. Mm-hmm. And so they're taking their money out one at a time. We've had some people that have needed some lump sums and that have exceeded what's in the money market, and we've had to go in and do that. And so then once you get down to, hey, I have to replenish this money market, we basically just look at the model and see where we're off. What has stayed up the most, what's down the most. We sell off the pieces that have stayed up, and we put those into the money market. And that allows us to allow those ones that have been down more to maybe recover going forward. Again, you have to believe in the things in your portfolio in order for that to work. And so that process is very good. Now, the other thing that we advocate with the clients, and we have a pretty good response to this in total, is having money at the bank, right? And so at some point in time, especially, let's say we had a recession coming, and even right now, I'm not seeing that in my indicators. I just talked about that in my summary. But if I did see that in my indicators, that's something that I would communicate to the clients and say, look, it might be time to start using some of that money we've saved at the bank for a while and turn off or lower the withdrawals that you have coming out of your accounts. Because, if we get a big downturn, it allows us to basically, wait until there's some recovery and we live off of that other money. And so, again, that's a little tough to go backwards in time and put that strategy in place if you don't already have it. But it is important to have a strategy like that. That's how we look at it, right? From a standpoint of long term, we use this replenishment of money market, have money on the side in case we have to try to turn off the withdrawal out of these accounts or lower them at least as far as that goes. So I've had quite a few clients ask, should I be lowering it and what have you? And I say, hey, so far you're still taking it from the money market. We don't have recession indicators, so I don't think so. Let's wait. Once we get some recession indicators that start to really signal that we have a recession coming in the next 12 months, I'll change that tone. But we're not there yet as far as that goes. So, it's an interesting question. It's a tough one. Generally speaking, you don't want to withdraw on these down markets, as much as possible, but it's not always possible, right?
Yeah, and if you have a solid financial plan, those plans account for down markets. If you run a Monte Carlo, there are periods where your returns are low, and so if your plan can withstand that, you should have the confidence that you'll be okay through this down market too.
Yeah, that's right, exactly. I mean, when we put together a retirement plan for somebody, we've got all their incomes coming in, all of their outflows that they want to spend, and their assets, and it'll tell us, because some of those Monte Carlo simulations are withdrawing money in bet down markets, kind of like what we're dealing with, right? And if it's still working at a high enough, probability of success, then, that's just what happens. You just kind of keep going. So there are some strategies, like I talked about, maybe to refine that, but that's a big piece of it, is making sure that your plan is still intact. And that's one of the nice things about Monte Carlo simulation. We can run it again at these lower levels and see, okay, how does it work? And so, we're kind of pushing that button every 6 months, trying to see what is going on. And, has your probability of success dropped way back? We need to look at some different strategies, right, as the market comes down. So I think it's pretty interesting.
Yeah. So our next question is kind of another withdrawal question is, I've saved a lot for retirement. I'm heading into retirement. How do I figure out how much I can spend?
This is actually one of the biggest questions we get on a constant basis, actually, is just, how much money can I spend in retirement? I think there's a complement to this, is how much money do I need to support this amount of spending? But those are flips of the same question to a certain degree. So now I'm heading into retirement, or I'm just retired, or whatever, along those lines, and I kind of want to figure out what my budget is and whatnot. And there's all these different rules that you can use. You can take a 4% withdrawal, but if you really dig into the 4% withdrawal, there's some caveats to it. You're looking at, you have to be the right age. You kind of need a 30-year retirement for that to work. But let's say you're 85. I mean, you take more than 4% most likely, right? And so that's where the Monte Carlo simulation comes in. And again, I'll share that with everybody here as far as that goes. Again, here we go, right? Somebody wants to know how much they can spend. And so we put in all of their expenses that they've got now, as much as possible that we can identify. We build in, all of their incomes that are coming in, Social Security, pensions, rental income, those type of things. And then we look at, what their asset base is and how that's constructed and where it is, how much is in the banks, how much is in the stock market, how much is in the bond market. We get all that in there, and then we can run this Monte Carlo simulation. And you guys have seen this before, but essentially we push this button, and we're able to run 1,000 scenarios. And in this particular case, 960 of them were successful.
Yeah.
Right? And so what would we do if we want to figure out the max they can spend?
So if we want to push the limits, we would solve for 85%. And so we have like kind of a super solve functionality, and it essentially takes our inputs and says, what can we do spending wise? And it'll bump up your spending a little bit, and then I'll get your 85. But longer the time horizon, like longer your retirement is, less that bump will be. So if you have say you're 85 and you expect only to live to 100, that 15 years versus someone that's in their 70s and expects to live to 100, that bump's going to be different.
Yeah, we literally have a super solve button in this particular program, and we can say solve for 85% probability of success, and we can have it just solve for how much money can be spent per year to make that happen. And we can update that and continue to look at that or what have you. But some people really like that. They just want to know the budget and know that they can feel like, okay, that works. Because when they're traveling, a budget for travel, right? Okay, I'm going to pick 3 trips. One's expensive, one's medium, and one's cheap. Which one can I really afford? Because it sure makes that trip a lot more fun when you can go knowing what you can afford. That's a huge deal.
Yeah, a guilt-free trip.
What's that?
Guilt-free trip.
Yeah, that's right. Because that's just my personal thing. Whenever you make a purchase that's above and beyond what you probably can really afford, it could be anything. Car, I've done that before. Trips and those types of things. When you're driving around in this nice car, but then you have this whole feeling of, well, I can't really afford this car. Or I'm at this great trip, but man, we probably overdid it. And I can solve for this, let's say at 85%, and say, okay, I can actually afford this. And man, I'm telling you, that's a big part of the trip. I mean, the whole object of the trip for me is just mental relaxation. So knowing that I'm, can afford it, it really does help. And maybe I'd go on a better trip than I might have thought, right? Just because, okay, I can really do this, and maybe I'd enjoy that. So I think it's a great question. There's lots of different ways of solving it. But I wouldn't do it any other way than Monte Carlo simulation personally. Just again, we've had so much experience with this over the years, and it really seems to work. I mean, real life. It's not just, we did this plan and then we never see these people again. We redo these for year after year after year, and we're getting to see, okay, this works. It has been pretty accurate and whatnot, and then we can see what happens in these big downturns and keep pushing these buttons. So I think it's worth looking at.
Yeah, so if you're close to retirement, I think it's time to start to go into the details, dig into the weeds with your retirement and figuring out how you have to spend. Because, when you're saving that money, you can have a rough, napkin math to figure out how much money you need for retirement. But when you actually get into it and you want to retire, at a point you can't really go back to working. And that's when you kind of want to make sure that you're in a good spot.
Yeah, I actually can make this argument for almost any age, too. I mean, we don't get asked this all the time because people are pretty happy with their standard of living. And let's say they're at 96%, like we just showed. Okay, good. But it would be interesting, for those people that are wondering what they could spend to solve at 85%. It's very easy, we can do it. And it'll give them an idea of what they could spend. Because sometimes things come up, and I've got clients that could afford more, and they don't do it because they don't think they could afford more. And that's okay. There's nothing wrong with that. But maybe there's something you're missing out on that you might have been able to do. Go back to visit your kids, a few more times or something than you thought you could, whatever it might be, right? Everybody's got different things that are important to them. So anyway, I think, solving for maximum income, spend, I think it's useful. It would help. It helps me, that's for sure.
Yep.
All right. So what do we got next?
So we have a market question. Is now a good time to invest in small cap stocks?
Okay. So small cap stocks actually did really well yesterday. Doing okay today. I mean, down, but down less, right? It's really interesting to see what's happening because what goes on historically is that when you have a downturn, basically what comes out of that downturn tends to be your larger cap stocks, your more established companies with great name recognition and cash flow, low debt, those type of things. Because people don't trust the market yet. They're not into that position of, wow, I can't lose. We get there. We got there in 2020. We got there in 2000. And so, and when you get to that position of I can't lose, that's later in that development. It kind of rotates through these different types of stocks. And small cap stocks are generally really, really run in the later stages. And it could be quite a ways away. In other words, you could have that big run in 2020, and now we've seen a lot of those stocks down, 50 to 80%. And that kind of pain to come all the way back and to make money on that, jump back, double again and what have you, I'd say generally that's probably about 5 years away before that really starts, because we got to go through these other cycles. Now, having said that, one of the things that's happened is that we have this new group of investors, tens of millions of people signed up with things like Robinhood during the pandemic, and we have a new individual investor group that has some sway, and partly because one of the things that has happening at least somewhat frequently is that they're buying call options on those particular stocks. And what without telling you all of the details of that, it just magnifies the money that they have, especially on a smaller stock. Because when they buy a call option, they only put up a fraction of the money for the number of shares that they still have some control over. But the firm like Robinhood or Schwab or TD Ameritrade, they actually have to buy some of that stock. So the more call options that are bought, the more these firms are buying, and all of a sudden you start to see a run up as far as that goes. And so I think that's what we're seeing. The ARC funds and all these different things have had some big, big runs. But so far, at least this year, those big runs have been short and then they fall back down, and we haven't been able to see them sustain. There's some profits to be made there if you're a trader, I suppose, which we don't do. But what really drives the market in the end is the institutions. And the institutions aren't going to run as a group into the small cap stocks. Historically, they've waited for these other cycles to happen. And so you're going to see the recovery come into these bigger companies that have more solid names and solid, track records, better cash flow positions, better cash positions, less debt, all those different things. Some of these small cap stocks don't have earnings yet. They might be the next Apple. And you could make a fortune getting into those small cap stocks early. I mean, if you can buy Apple before it became Apple, wow, you've done really, really well. The problem is that, for every Apple that became Apple, there's a whole lot of things we've never heard of before because they went out of business, right? I mean, I remember the story about eToys, which was so big, huge company, crushing Amazon, actually. And so there's this big debate about which one should you have, eToys or Amazon. I bet you a lot of people have never heard of eToys because it went out of business. Everybody's heard of Amazon. So you don't know for sure which one it is going to be. Sometimes it's better to buy an ETF with a few hundred of those stocks. That's what ARC is doing, right? So I think that works as far as that goes. But I'm a little leery of sustainability of small cap stock growth. If you really want to hang in there and not trade them until later on in the cycle. I think this is going to be more of a bigger company, mid-sized company gains that come out of this. Now, whether this is growth stocks or value, that's a really big argument. But if we just ignore that and you just went by market cap from small cap, mid cap to large cap, I'd be overweighted in large cap in this environment as I'm waiting for this market to come back. And we have seen large cap do quite well in these big days too. So it's not like you're losing out too badly. So anyway, it's a very complicated scenario right now, but I think it's worth looking at. I'm not invested heavily in small caps right now. We were in 2020 during that run. That worked out great. But we diversified out of those just because they tend to eventually come back down, which is exactly what happened.
Yeah, and also with the market, we're not sure if it's going up or down right now. Are we having just a bounce, or are we having a sustained upward trend?
Right.
And so, are we catching a knife that's falling? Right, if we invest in small caps too early,
Right.
And so you want to be careful of making any big commitments. Maybe you do a small if you're feeling confident that the market's going to return. Maybe you take that small portion of stock.
Yeah, exactly. Yep. Yeah, I agree. I think it's time to watch and wait and see what happens. again, we're not traders. So if you're looking to trade, maybe, yeah, just because they are kind of low. But that's probably the only way I would do it. I'd be trading. And actually, if you're buying call option, you're forced to trade because the option's going to expire. So you're going to have to sell that option out, hopefully at some higher price before it expires, because they expire at zero. And so, if that's what's driving it, fine. I don't have a significant problem with that. And there are people that do that. It's just not our thing. We deal with really, I think, big quantity of assets, of the household's assets. So I'm not interested in getting involved in some of these really crazy things. But I would stay away from them at the moment because I'm more of a longer-term investor as far as that goes.
So our next question is, do you have any advice for a novice investor? How do I look at a company and evaluate them? Can I see what kind of ratios am I looking at?
Yeah, I think this is kind of interesting. I have seen over the years and talking to different people, I get asked questions about, what should I do and what have you. And then I ask them what they are doing. And it's kind of amazing to me. I mean, there's some people doing some really aggressive things. I mean, really aggressive. And they've been investing for 3 months or 6 months. And I don't know. I'm sure that there are lots of stories where it works. But just personally, it's really difficult. I've been doing this for 35 years now, just professionally, and then I was obviously an investor before I became licensed. And one of the things that I've learned over the years is that it's incredibly complex, and it's super hard to learn. And it's sort of like, hey, I wake up one day and I'm going to play baseball, right? And so you go from deciding to play baseball, I'm a novice at that thought, to playing in the professional leagues, trying to hit 100-mile-an-hour fastball and 96-mile-an-hour sliders and what have you, right? And that's what I see people doing. The novices are just going for it. And again, in the right market, you look like a genius. In 2020, when things were flying, it was difficult to lose money in that kind of market. You just throw stuff out there. It was really, really hot. That's not the market that we have now, and it's not normally the market we have anyway. So a novice, in my opinion, should have a pretty good amount of their money right in the big old indexes. The S&P 500, like the Vanguard S&P 500 VOO is the symbol for the ETF, or the Vanguard Total Stock Market Index, which is VTI, right? So that should be where most of the money goes. But the question was about individual stocks and what you look for in those individual stocks. I guess my first thought would be keep that portion of your portfolio smaller than if you're a novice, than the bigger portion of the portfolio. I mean, even for us, we have only a few individual stocks that we have in our portfolio at any point in time, and most of the money's in the overall markets just because it is so difficult to get the right stocks. Now, what I look for personally has a lot to do with cash flow. So what they call price to cash flow, that's a big one for me, especially in this market right now. Maybe not as important in 2020. Again, you could kind of throw some of these out the window in certain markets because nobody's paying attention to price to cash flow in 2020. They were just looking at the innovative possibilities of that company, and that was what people were buying. And so you have to change your methodology sometimes. Right now, earnings, so price to earnings, sales, price to sales, and price to cash flow. That's what I'm looking at right now, are those particular areas. And then I guess the last thing is just cash on hand, right, versus debt in total. So you'd like to have companies that have great name recognition, relatively low debt compared to their cash on hand, great cash flow, good PE ratios, at least reasonable, and what have you. So I think that's what's going to lead us out of this. And so that's what, that's where the Nvidias are, the Apples are, the Microsofts are, even the JP Morgans and some of these, big names that are out there, the Home Depots, even Target, which is, got pounded. Still really a great name, has great everything, missed some earnings and they got hit for that. But, Starbucks, which is growing like wildfire actually and doing quite well, Stock is still down a bunch, so I like that, right? Right now, I think this is sort of a bottom picking market in the really good names. And I'm sticking with things that I think, almost everybody would recognize, to be honest. And it's, more for my own portfolio than for my clients, but I'd be cautious here not to get too carried away with really speculative things, just because we're in a market that could fall another 10, 15, 20% for all we know. We don't know, like you said, whether this is a recovery or not.
Yeah. And if you're investing in individual stocks, sometimes it's a long game. You're not going to get a return for maybe 2, 3 years or even 5 years. And so you have to kind of pick something that you're really kind of trusting. If you don't believe in this company, should you be investing in it?
That's a good point. To my own portfolio personally, outside of my broad market exposure, I have a list of about 20 stocks that I'm invested in, and that's exactly it. Every time I look at it, I think to myself, if that drops, do I want to buy more? Do I believe in it? When I look at it and I look at the cash flow, I look at the name, I look at the earnings, price ratios, all those things, you have to believe in that stock. And that eliminates a lot of stocks for me, because there are certain times where you can do speculative play, that are some great things that are out there. But when I'm looking at individual stocks right now, I have to really believe that company's going to be significantly higher in price than the market might be in 5 years, let's say. Maybe it's low, but outdid the market 5 years from now. Maybe it's way higher, so who knows? But so Home Depot, let's say, just for example, I look at Home Depot, I think to myself, okay, whatever's happening right now with the price, will Home Depot be able to outperform the market going forward? I think so, right? Might not be true, but I believe that, and so when it drops and I want to rebalance my portfolio, I'm going to buy some more Home Depot. They're high conviction companies, Nvidia, all that kind of thing. So anyway, that's a good point.
Yeah, and if you feel like instead of a company, you believe in a trend, you can try and look for an ETF that meets that trend.
Yeah.
So if you really believe in electric cars and autonomous driving,
Right.
you can find an ETF for that. And so you could target based on your belief systems and what you have conviction in. That way you can stay in the market.
Yeah, I'm doing the same thing, actually. So I look at that and I say to myself, okay, will that category be bigger in 5 years? And so there's a ETF that iShares called iDrive, IDRV, that I have. Cloud computing is another one I think will be bigger in 5 years. Clean energy, I like, for a 5-year run here. And, just trying to accumulate healthcare, I like at this levels, 5 years from now. And so, you're exactly right. You can buy an ETF that's kind of buying the entire ecosystem of that particular category. And cybersecurity is another one that I have too. So you can kind of combine. You got my portfolios. I've got this broad index pieces, and I've got these kind of targeted ETFs like cloud computing, and then I have some individual stocks that I really believe in. Right. So that again, that's just my outlook on it. I think there's some opportunities here in this particular downturn to try to accumulate some of those. And I've been very happy, at least in the up days, that my portfolio has outperformed the market. So I'm hopeful that if the market does recovery, my portfolio will outperform the market during that recovery period. So we'll see what happens.
Yeah, but you have to remember when you're introducing these individual stocks, you're going to add volatility.
Yeah.
And so your up days could be worse.
Yeah.
They could be better, but you're not going to be as close to the market. And so you're going to have to be able to stomach that kind of movement.
Yeah, exactly. Most likely you'll fall more on the down days because, what you're really doing is just adding beta, what they call beta, which is just volatility versus the market. And so, again, that could be a bad thing. You have to be very careful when the market's coming down, because you're actually adding more volatility, which most likely means you're going to come down further. And again, I think that's why you need conviction in those pieces that you do have if you want to continue to buy, and maybe you stretch your timeline if possible. So again, it depends on your age and your situation as whether you should be doing that. And what we're talking about here isn't something I do for the clients per se. We stick to the basics with the clients, but and that seems to work quite well. It's just, again, just trying to answer the question from my own personal experience. All right. You going to ask another question, or?
Yeah,
Right.
we can ask this question. What types of risks should I be insuring against?
Ah, okay. Yeah, that's a good question. It comes up quite often, what do you insure against? And actually, Easton found a chart for us that we'll share here. It's kind of, I think, a good way to look at it. And so it kind of depends on the situation, right? So if we look at this chart, how often does it happen? Frequency. And what's it going to cost you? Severity of consequences. So if it doesn't happen very often, and there isn't much of a frequency issue, doesn't happen. I'm sorry, if it doesn't cost you much, then you just deal with it. Yeah. So I mean, what's an example of something that would fit in that category?
So if it's both low, let's say I have a set of glasses I bought from IKEA, and so I might drop one every couple of years.
Yeah.
I'm not going to insure against the destruction of these cups because I can easily replace it and it's not a big cost to me.
Yeah, that's a good point. Exactly. So you don't want to insure your dishes.
Yeah.
Basically, and that's pretty obvious. But we're just trying to give some examples. But let's say that it doesn't happen very often, but it has a really high cost to you. That's what you want to insure, right? So what are some examples of things that fit into that category?
So like flood insurance, not every time your house is going to get flooded, but when it does, it's pretty catastrophic for you. And so that's when you kind of want to get these insurance, whether it be for health, any kind of big health thing, long-term care, car insurance. So these big events that don't happen often.
Yeah, we have a pretty high deductible on our homeowners insurance, but we had a flood. Essentially we had 800 square feet of hardwood floor that got wiped out by a leaky pipe in the wall. I was really glad to have that insurance because it was really expensive. It was a lot more than the deductible that I had to pay. So yeah, it's exactly right. High cost things might not happen very often, auto accident, whatever it might be. Then you can get into these situations where it happens all the time, but there's low cost, right? And so you just want to try to find a way to reduce those because you can't really insure them as far as that goes. For me, I don't know, between my kids and myself, I get a lot of nails in the tires or different things that keep having to fix, so you try to figure out how to avoid that, as far as that goes, and where to park has a lot to do with that. And then of course the last one is something happens all the time that has a high consequence to you. You just want to avoid those. Those are definitely like high risk behaviors. So, and again, this is controversial, but skydiving, which, I have a friend that loves skydiving, but that's a high risk thing. He does it all the time. And honestly, the insurance companies won't even really insure that.
No.
At least for a reasonable cost, right?
They might carve it out. So like they say, we'll give you insurance for everything, but if you have a skydiving accident, we won't cover that. So
I've seen that in life insurance policies over the years where they have a carve out for if you fly in your small plane, your Cessna, and you crash, we don't pay for that, right? And they can make up anything, but that's something that you're flying all the time in that Cessna. It's very high risk, and in their opinion, you should be avoiding it.
Yeah,
right? And they're not going to pay for it. So anyway, insure those things that don't happen very often that have a high cost to you is really what it comes down to as far as that goes. So perfect. Really happy again that everybody was able to join us today. Hopefully we're able to give you some advice on how to improve your retirement. Again, if you want to subscribe to the channel, you can do that by hitting the subscribe button. Hit the little bell for when we do notice. If you'd like to meet with us and just chat about your situation, you can do that also. You go to the book appointment button, and then basically you can set up a 30-minute time with Easton or I on a phone or video, and we'd be happy to meet with you. I want to thank everybody so much for joining us today, and I look forward to seeing you not next week. We will not be here next week, but the week after. Right? So we're taking a little break next week. I'm going to go to my son's graduation, actually, which is kind of exciting. Get one of them out of school. So anyway, that 2 weeks from now, we'll see you then.